Welcome to another edition of the Energy Week podcast. Ryan Ray alongside the smartest person I know, Dr. Ellen-Wald. Ellen, how's it going?
Oh, everything is fantastic. It is a lovely 80-degree day here in North Florida.
That's nice.
I hear the Northeast is covered in snow, which makes it even better.
I wonder if they're using natural gas too soon. Okay, we'll let that go. It was cold here in Texas, and so it was warm last week, but we've got a cold front that's moved in, and it will be here for I pressed the wrong button. We'll be here for some time. So anyways, Dr. Wald, real quick. I'm taking a look through our notes, and we don't have anything about the Aramco IPO. It did hit the $2 trillion valuation, miraculously, surprisingly, not surprisingly. I saw you in a little bit of a Twitter kerfuffle about whether or not it was a good investment. So give us a quick rundown of, before we go to holiday, anything that folks might be curious about the Aramco IPO that they should be watching for, or maybe they missed.
Well, one of the things people should realize is that this is on the Saudi stock market, and the Saudi stock market does not trade on Friday and Saturday, which is their weekend. So unlike the U.S., which has a different weekend, they have their own weekend. So they were trading yesterday on Sunday, and that's common. That's regional. Like all the Gulf countries have that weekend. Yeah, interesting, right? Learn something new. And then I did get in a little kerfuffle about the whether or not the Aramco IPO is a success, and obviously that is based on what kind of metrics you want to measure it by. If you want to take the original metrics, no, it's not a success. If you want to make up your own new metrics and your own new goalposts, then by all means, you can call it a success anytime you want. So yeah, it's interesting because you're going to see a lot of media, particularly coming out of the region, declaring it a great success. What was also interesting, though, was that Saudi Arabia's unemployment numbers came out, and unemployment was down like 0.3% there, which I think they're trying to celebrate, but is really, in my mind, very hard to celebrate as some sort of like the Vision 2030 program of the Prince is going great, because, a 0.3 drop in unemployment. It's really, I don't know all that much about how Saudi Arabia measures employment. I don't know if they know all that much about how they measure employment, but it's not clear whether, you can't necessarily pin that on these reforms. And a lot of people seem to have this assumption that somehow the Aramco IPO is going to now power this Vision 2030 forward. And, when you look at the amount of money that's raised, just because a stock reaches a certain level or is valued at a certain thing doesn't mean that anyone is actually making any money off of it, because you have to actually sell the stock to make money. It's like
that's a key point that's missed there by a lot of people. Like when you talk about billionaires' wealth with the U.S. political debate, like all these billionaires, like, well, they don't really actually have the cash. They don't actually. They have it's in stock. So if they sell it, then the stock price goes down. So I'm glad you pointed that out. A lot of people don't think about that.
Yes. So, and it doesn't seem that people have been selling, which is interesting because, I think you might think that a lot of, like in a typical IPO, if it goes up enough, it's not like it went up a whole lot because it was valued at 1.7 trillion to start with. So, but the share prices have gone up and they've continued to go up. The rate at which it's increasing is slowing, if that makes sense. Well, so it's not going up as much every day as it did in the beginning, and that's to be expected, obviously. But you can't. What will really be interesting is will people want to cash out? When will they want to cash out? And is there? I haven't studied the ebb and flow of typical IPOs and when people start selling. I know there's generally a lockup period for owners of the firm. Well, so there's a lockout period for them to sell more, to put more shares on the market of 6 months. And then there was also this weird contractual lockup with the banks for 12 months, but those, I don't think they ended up using those banks, that was the big international banks. So I don't know if that contractual lockup applies at all in this case. So I think it's really just a 6-month lockup. individual, retail investors are incentivized not to sell, because if they hang on for 6 months, then they get like a certain number of extra bonus shares. But not everyone is incentivized. You've got big sovereign wealth funds, wealthy Saudis, businesses, and if none of them sell like forever, I mean, that's obviously then because they are either they've somehow got like the longest term ideas of like money management, like, I mean, some people go into buying stocks with like, I'm going to buy, GE and I'm going to hold it for 30 years and then I'm going to sell it when I retire. And like, that's one thing. But I think you have to ask yourself, is there a measure of like pressure on these people not to sell the stock in order to keep the price up?
Right.
Then you also have what's happening now is you've got Aramco is now going to be included in all of these ETF and index funds. So we've got the MSCI, the FTSE, and all these other ones where it's now going to be included, which means that if someone in the US is like invested in ETF funds that use these indexes, then they're technically invested in Aramco. Mm-hmm. So just so you know, heads up.
Okay. Well, that is your Aramco IPO update brought to you by Dr. Energy. For all more Aramco stuff, because we will be off a few weeks, go to Ellen's website, which is?
Which is ellen-wald.com. But really, also, we have a lot of the Aramco kind of more details about it on our company website, which is transversalconsulting.com, or just follow me on Twitter because I can't stop talking about it.
And you had a lovely map of Canada on your website, on Twitter last night, and so I really appreciated that.
Don't even get me started on the Arabian Gulf versus Persian Gulf debate. I really should have seen that one coming before I posted that picture, because I'm not, you know what I really should have done? So I'm looking at the picture now and I have this red pen that's like placed strategically across F, which is Tehran. Mm-hmm. And I really should have strategically placed that pen across C, Persian Gulf, so as to avoid the whole Arabian versus Persian Gulf debate, which I'm just going to say right now to anyone listening. Okay, if you want to call it Arabian Gulf, that's great. That's awesome. More power to you. But just realize that in the U.S., we're all going to call it the Persian Gulf, because that's what we've been calling it for years, especially anyone who was alive during what is now called the First Iraq War, which was then called the Persian Gulf War. Mm-hmm. Sorry, you're just never going to convince us otherwise. It's not a slight. It's just the way it is.
Well,
deal with it.
Yeah, I saw someone getting a little serious. That's why I made a joke, because in Texas, everything outside Texas is Canada. So I was like, well, let's bring a little levity to
other than Mexico.
Well, other than Mexico. So that's right. So, but we do have Dr. Foreman coming on here in a few minutes. So a couple of things to get to. We've talked about this. This was going to be the thing that changed everything, the phase one trade deal. And yet it disappointed everyone. So did they actually sign this thing yet?
So no.
The markets have responded.
Wait. They're talking about signing it maybe at Davos.
Really? I did not see that.
They're like, well, both President Trump and President Xi will be at Davos. So, maybe they're going to sign it there. Apparently they have to translate it first. I don't know if that means they're translating it from English to Chinese or Chinese to English or some other neutral language. Did they still sign treaties in French? I know that used to be like the language of diplomacy. So maybe they're going to translate it into French and sign it. I don't know.
Interesting.
That's a good question.
And when is the Davos
meeting? I do not know the answer.
When is that?
Soon. It's like January. I don't know this because I'm not like actually going. Sometimes I get these questions like, "Oh, are you going to Davos?" I'm like, "No, I'm nowhere near that important." It's later in January. It's like the 21st, I think.
It will be interesting, even though it hasn't been signed. It does feel like, because the way that Trump would retroactively come back and triple the tariffs, that it probably is a done deal. Because if they don't sign it in soon, then you would assume that he would come back and say, "Well, you guys owe tariffs for." From when we did sign it to when we're supposed to sign it. But
yeah.
So
what's interesting is this idea of like snapback. Remember, we had the idea of the snapback sanctions with the JCPOA, and everyone was like, "Yeah, but are they really snapback sanctions? Like, can you really is anyone really going to put those sanctions back?" And so it's interesting, but like, do you really think Trump wouldn't snap back tariffs?
At least,
I don't think there's any question there.
Right. At least threaten.
Like he would totally do it.
Right. But and we're not going to get into the agriculture export debate on this show, I don't think, today. But that being said, I know there's a lot of criticism potentially of the Trump Phase 1 trade deal as it pertains to the U.S. side of things. But that did not stop the markets from going, hey, we're going to feel better about things. And so the markets responded. And has Goldman Sachs reissued their new prediction yet? That's the real question.
I actually thought I saw something about that. Like it was like like new commodities updates or something. So it's possible that they did. They should have seen that one coming. Isn't WTI like over 60?
It was close. I haven't looked at it. Let me pull it up here right now. It's funny though, because one of the lines, it is at $60.19 at the time of this recording. It says, investors remain cautious as growth in China was expected to slow down further next year, with the government likely to set its growth target at about 6% in 2020 compared to 6 to 6.5% this year. And it's like, well, okay, hold on. The other day, the market has been telling us, the market allegedly has been telling that who is the spokesperson for the market? I need to talk to that guy. We need to get the spokesperson for the market on the podcast. But the market,
yes.
The market has been telling us, air quotes, that it's been waiting on the trade deal. But now the Phase 1 trade deal is done. Now we're concerned about China growth despite that. So was this the reason just to keep the market suppressed for the big people who put a lot of money into the market? That would be my question to you, Ms. Wald.
Yeah, I mean, it's funny because that was actually one of the questions that I was hoping we could talk to Dr. Foreman about is, like, now that this is signed and the market has done its little dance, when can we expect to see actual economic indicators shift? So, if China, China sets these targets, so China could be like, okay, now we're changing our targets, but And we all know that China's economic data is all weird anyway and not really to be trusted. But, it's likely that we're going to get negative economic indicators in January because it's not like you snap your fingers and like everything is suddenly fixed. Like we get a market bump because people believe it will be better. There's perception that it's going to be better in the future, but that doesn't mean that like suddenly, like distillate demand is going to go up in January. Right. It could take until like March to really feel the economic effects of this Phase 1. So, I wouldn't be surprised if we see the market kind of taking a step back in January when more negative economic indicators come out, just because it's, there's a lag.
So, yeah, and if one of our listeners is more up to speed on the ag stuff, hit us a note. Ellen, you might know this answer, but help me understand this. Let me just think. If we're selling agricultural products, which seem to be a lot of what's being talked here, I'm a potentially, and I don't follow the ag market that close, so potentially you could have a stockpile of corn or soybean or whatever that's sitting around that you could immediately ship over today, right? So you could immediately export that. But the real impact of that would be when farmers start to plant and plow and do all that stuff in the springtime. You would see an increase, at least from the oil and gas side of things, or the retail side of things, more tractors or more diesel fuel being used or fertilizer. That would begin to see where you could see a slight impact. But then when harvest season rolls around next fall, and then the product begins to be shipped across seas, it would seem that it would take a while before the full ramifications of all of this stuff, as you're indicating, is played out. And unless I'm missing something there, it seemed like it would take, like you're saying, maybe even 8 to 9 months or 10 months, I guess, before you could actually see where these numbers really land until late next year. Or is there something I'm missing in the intermediate there that would be a better indicator?
Well, I would say, first of all, I know not that much about agriculture, and most of it comes from like historical studies. So I would say the very first indicator would probably be seed purchases. Yep.
Right.
Unless they all like have, they planted for seed and then they stored it. I would say like seed purchases and fertilizer purchases. I don't know what the agricultural cycles in the U.S. are. Hog hogs are really
Hogs.
important.
Yep.
As we talked about last week, we
Right.
should really keep our eye on hog indicators.
Hog. I like
What's
that.
interesting is
the hog indicator index. We need the
Yes.
HG. We need to start at the hog indicator index.
we'd like a
HID.
hog indicator index. Yes, and then we're going to get a huge debate over like what number, like what number do you assign swine flu? You know, what kind of like negative multiplier is that?
No,
So-
it's out there, I'm sure.
I do. So it's interesting. So not to like dredge up old things, but so I did go to graduate school with a guy who is still married to a lovely woman whose father is basically like owns a giant farm, like big time agribusiness, you know, not like a small family farm, but like big time agribusiness, like in Iowa and like, or somewhere out there, and like plants corn. I kind of wonder if I could like mine that connection, be like, hey, can I like talk to your father about his, you know, how this is affecting his planning for his, you know,
Right.
For his farm. I mean, he could be like, you know what, like we've got this stuff it's all on spreadsheets and we're not changing it.
Mm-hmm.
You know, it could be something like that, or it could be like, yeah, I just talked to my tractor guy.
Right. No, I think
or my seed guy right now. I don't know. It would be a good question.
But you make a good distinction there, because if you're talking about livestock, obviously that's a different cycle than farming as plants are, because of weather and things like that. So that's a good thing that you could watch for the impact on the hogs, or if it's cattle or anything like that. You could start to monitor that side of things. But as for the agricultural side, it is going to take a little bit. Seeds, tractors. The other thing is, I don't know this answer as well. This is where I'm agriculturally illiterate. But let's just say we used 1 million acres last year to farm. Will we then also see new leases for farmers, or more land being purchased, or did we use 1 million and it was subsidized by the government? So we still. That million could actually be, it just went for nothing essentially because it's being subsidized. So could we use that million and then export that out to China? Does that make sense? So I think the land use would be another thing.
I think we've come to the conclusion that we are not agriculture experts, but we should talk.
We've got a lot of questions about it. A lot of questions.
Yeah.
A lot of questions.
If you're an agriculture expert out there, hit us up, send us a message.
But
answer our questions.
True, but if you take the headlines from these other publications, then you know that you just go out spouting stuff and people believe you. So we could do that as well.
We could just do that. Yeah, we could just say we actually are agriculture experts, because I have a garden. I have a garden and I grow things.
I live in a pecan orchard, actually. So it's not mine.
Well, there you go.
So yeah,
I think we are experts.
We're basically experts. We've got this thing.
I got to admit, we planted 3 rows of radishes. I have 1 radish so far. 1. I planted 8 cauliflower plants. I have 0 cauliflowers. I have lovely cauliflower leaves and 0 cauliflowers.
Well, it's because they're called cauliflowers. Maybe they're offended if you're not giving them the proper name.
That's true. That's true.
Maybe is it did you say cauliflower, Nate? Or did you say cauliflower? Cauliflower. It's probably a redneck deal.
I grew up saying cauliflower, and then I got switched. So it might be a New England thing to say cauliflower.
I don't know. We don't say
the only thing I can grow
so.
is arugula.
How many of those have you produced?
A lot, more than I want to eat. There's only so much arugula salad one can eat before it's enough already. So but this now qualifies me to discuss agricultural indicators for the economy.
Well,
clearly.
hit Trump up, tell him that you want to export those as part of the new phase 1 trade deal, and get them on the ship.
Okay.
One more story that will probably take us a few minutes before we get Dr. Foreman on, from our favorite publication, the journal Shale Slowdown takes economic toll. Shocker. U.S. regions that benefited as fracking boomed are seeing declines in economic activity as producers reduce employment spending. Who would have ever thought that? Didn't you read
this story about the Bakken 3 years ago? The exact same one?
Yeah, I think you came on the Global Energy Leaders podcast. We talked about it, if I remember correctly.
Yeah. It's a boom and bust, right? These are boom and bust towns. This is the way it is. I'm sorry.
Well, and you're seeing now out in Midland, there was a story we covered on the Texas Oil and Gas podcast a week or two ago that rent's declining. There was a story a few weeks back about hotel prices declining. And so you are seeing that the supply and demand metrics, if you will, are shifting a little bit out there, and enough to people are reducing prices, which is probably one of the best indicators that there is of what's going on, is people adjusting their prices.
And yet, not to like jump the gun on the API report, but we're still producing record amounts of crude oil.
Well, Ellen, it's funny that you say that, because we covered a story from the Houston Chronicle this morning, and let's see if I can pull it up. But it said essentially, this was I don't know if you can follow the logic here, but it says that if we do not increase drilling, then production will fall off.
Oh, so they're anticipating. Okay.
So I don't know how they got that math, that if you don't drill for something, it will not be produced. But the Chronicle has deduced that that eventually, if we don't keep drilling, that the
really,
yeah,
it doesn't just come up on its own. You mean?
No, it doesn't. It doesn't.
It doesn't.
Surprisingly enough. I thought it just kind of bubbled up, but so yes, you are right. The Midlands is obviously benefited a lot from it, but then you have other towns, and even it mentions here Hobbs and Carlsbad and Pecos, and all these little towns out here who have hotels. And back when I first started going to Pecos, there was like one little restaurant. Now you go out there's hotels, and it's not. Listen, it ain't Dallas Fort Worth, but compared to where it was, it is fundamentally different. But as you mentioned, these are the pros and the cons. You build the hotel or whatever, and you're hoping that the market stays up. But one of the things you talked about before is good time to remind people is it's the ancillary jobs that are really the ones that get left out of these economic indicators. I talked to someone from the Dallas Fed. I pointed this out to him one time about. It was an economist there, and I pointed out some of my issues with these indicators, and I started talking about some of the things that we discussed, and he was sympathetic and understood, but basically said, well, we just can't track all that stuff. But that's when you actually start to see what's going on, because when the rent prices go down in the hotel, in the apartments, or the hotels start, that's actually an indicator of not of. The Fed takes you get a number that you turn to the government, and they go and they talk to businesses and that with that classification, and they kind of run the numbers based upon that. But the rent prices or the metrics of fuel usage, stuff like that, those are actually implications of what's actually going on better, I think, in the economy than maybe one subset of the industry. The subset could tell a story, but companies like myself or your consulting firm, we're not being measured in those studies, and so, but there's better indicators, I think, to actually understand the industry as a whole, what's going on, rather than just a subset of numbers that you turn into the government.
Precisely.
The real question is, this time next year, what will the headline read? I know you don't make predictions. What
will the headline read?
Because
can I tell you my other favorite headline from the Wall Street Journal about oil, which was like, I'll tell you my thought about this. First of all, everyone knows that I love Wall Street Journal reporters in general. We're all friends, but investors doubt OPEC cuts can boost prices. And I read that. I was like, did someone write this last week or the week before and forget to push, publish, and so then they just did it today? Because I think we all knew that 2 weeks ago.
Well, it's been funny because I'm glad you brought that up, because I think it was Bloomberg who was running a handful of stories about, or maybe CNBC I saw. You kind of go into it with the anticipation of what might happen, and then once the action happens, then they debate whether the action that they theorize would happen actually impacts anything. Instead of just writing this article, OPEC's going to cut stuff, but it won't matter. That's what I want to hear before they do it. And why they should do this instead, or whatever you think the thesis is. But I don't know if you saw those, but I saw a ton of debate about whether or not they're going to be in compliance and the same old stuff. I was like,
oh yeah.
Right.
The first thing that was like that was not the first question, but basically like the second question asked was, how are you going to assure us that you're going to be in compliance? And the answer to that was, we've brought the oil ministers from Nigeria and Iraq out to the press conference, and they're now going to like beat their chests and rend their clothes to try to, convince you that they're actually going to comply. And this is the explanation we got. Nigeria basically said, we are already complying. We have brought our production into compliance already. So rah us, Iraq. We blame the Kurds. End of story. It was a little longer than that, but it basically boiled down to we blame the Kurds.
Oh, the Kurds.
That is actually what happened. Yeah, that's what happened at the press conference. So you can take it or leave it. But and Novak left before that question even got. It was like he left. I was like, is he leaving? He's sleeping. He's leaving. Oh no, he was just up in the library doing a sit down one-on-one with like CNBC or something.
So this is this one of the notes in this piece here. It says, if OPEC really wanted to boost prices, they should have ran the cuts through the entirety of 2020. The fact they are reevaluating in March, that's causing some uncertainty. And this is the thing where it's like, I understand what you were saying, but we do. If you presume compliance till March, let's just say you do, well, then you do have an indication of the numbers roughly from OPEC between now and March. Now, you don't have to presume compliance, but it's like, well, if they would have done this, then it would be different. It's like, well okay, but they didn't.
Not necessarily.
Right. So it's like, well, it doesn't mean they don't change their mind in June or whatever. So.
Yeah, the biggest issue is that they're going to meet again in March in Vienna, and they're only going to have 1 month of data to basically look at. So we're only going to know really. We might have February data, but like it will be iffy because it's really the beginning of March. So we're gonna have January data from secondary and from OPEC, and we'll probably have secondary for February. But that's not a lot to go on. Iraq can just be like, we blame the Kurds again.
Yeah, well, blame the Kurds. # blame the Kurds. But that would lend you to think that they're more likely than not going to extend the cuts because they're going to get, if what you're saying is true, they're going to get there, and then they're going to say, well, we don't have enough data, we're going to go ahead and push it till June.
Yeah.
But then
exactly. Or the cuts are working.
The cuts are working.
We're going to continue them.
But then the article will read, if they would have extended it to the end of the year, we'd feel better. So.
Oh my God! If they would extend them until the end of time, infinity. Yes. Just put an infinity symbol next to the cuts.
A permanent cut.
Yeah.
Dr. Foreman,
why don't you just stop producing altogether, OPEC?
No doubt.
Then we'll be happy.
No doubt. And up next, making his final appearance for the year, I should say, is Dr. Dean Foreman with the American Petroleum Institute. Dr. Foreman, it is lovely to have you on. Haven't spoke to you since Thanksgiving. I hope you had a great Thanksgiving. And we are preparing to head off for the rest of the holiday season, Christmas, Hanukkah, New Year's, etc. So hope that goes well for you and your family. How are you doing, sir?
Doing great. Thank you. It's great to be with you as usual. And I, too, am looking forward to a break.
I left off Festivus. That's probably my favorite one from Seinfeld. That's my actual favorite holiday. We could do that with the oil and gas reporters, Ellen. We have a lot of problems to air out to people. So, Dr. Foreman, let's get into it. This report will come out on December 19th, API.org. We will link to all of that in the show notes. Let's talk about the thing that stood out in the executive summary to me. The charts were fascinating as always, but the executive summary said the greatest petroleum demand for the month of November, 21 million barrels per day. Break that down for me a little bit.
It's funny. I've been speaking at several events this last month, including one in Houston where an industry member actually stood up and said, in the United States, gasoline and diesel demand hasn't gone up, but maybe one out of the last 5 or 6 years. And I'm thinking, for the monthly statistics and the way we publish these and survey industry and reconcile the EIA, here we are 2 months in a row, October and November, with records for U.S. petroleum demand in each month. And the demise of oil and gas has basically been way over predicted. We're not even close. And there is a rotation in where that demand's coming from. A lot of it's jet fuel, and a lot of it is this renaissance in refining and petrochemicals that we've seen as a result of the U.S. energy revolution. But even with that, gasoline and diesel, while not on a year-to-date basis up year to year, are darn close to their records. So this is reflective of underlying strength in the U.S. economy. It's reflective of the dependence on liquid fuels in our transportation sector and just the sheer scale of it in the United States and the lifestyles that go with it. So that said, here we are, record demand for those months. Production sitting at records, exports sitting at records, yet prices down more than 20% year on year. So it's a win for the industry in the sense that it's through innovation continuing to set these records, but it's a win for consumers ultimately.
So I haven't brought it up a long time, but it is cold. It is the winter. Tell us about the ducks. We need to know about the ducks. We haven't talked about the ducks in a few times. So I see you do mention here that production set a new record, and that is obviously believed to be because of the ducks keeping production numbers up. What can you tell us about, as we go into the new year, how you guys been monitoring the ducks, the falling of the rig count, production, and where do we expect these numbers to continue to go, or at least according to the historical trend?
Ryan, it's a fantastic question. It is sort of the $20 question or the biggest one of the day, in the sense that the drilled but uncompleted wells coming down, this backlog of them that the U.S. Energy Information Administration estimates, is one source as we get new infrastructure of where you complete a well, you can bring that production to market. It wasn't there before. The other thing that's silently there, though, and equally important, is if we look at EIA's drilling productivity report, the same one that produces this spreadsheet of the ducks, they're also showing the productivity trends have continued to rise, be solid and rising. And it's that coupling together of solid rising productivity with the ability to bring more of stuff that was pent up and just looking for market. That combination is what's led really to more production coming on stream as we move forward. And then there's this third component, which is often overlooked by the market, which is that the decline rates of the legacy or existing production have continued to basically not be nearly as much as people might think in general. So as shale has become the majority of U.S. production, the Barnett Shale is the perfect example, sitting right where you are, right? It peaked several years ago at 5.7 billion cubic feet per day. And despite 4 years of essentially no drilling, I mean, literally on average 60 to 70 drilling permits per year, from in its boom time from 1,200 or more per year, right? But with almost no drilling in 4 years, it's gone from a little over 5 billion cubic feet per day down to 2.9 so far this year. So that's just an object lesson in how sticky this production is, how long it can continue, and why the U.S. energy revolution, when you add productivity with this infrastructure plus the backlog of ducks, and now the fact that the decline rates seem to be relatively modest, that's a recipe for continued production growth.
So one quick follow-up on the ducks, Ellen, and I'll let you hop in here, is if I told you we had reduced the ducks by 131, you would presume that most of those are in the Permian, but that's not the case. Actually, the Permian is fourth on the list. I believe you got the Anadarko at 58, the Appalachian at 25, Eagle Ford at 24, and then the Permian at 10, and the the Permian at 20, the Niobrara at 10. The Haynesville and Bakken both added a combined 6 ducks. It's kind of shocking that when you think about it, that the Anadarko Basin is actually the one putting the ducks online more so than the Permian. And the Permian obviously has a substantial more. Any insight or reason why you see that's the trend at this time?
I haven't really looked at the geographic mix of it. It would make sense, as the Permian is the majority of that inventory of ducks, that those should be the ones that are getting monetized as as you see more infrastructure coming on stream. And a lot of the new infrastructure really is out of the Permian. So that is a bit of a mystery. That said, the Anadarko Basin also has potential. It's continued. So net, if you have that, depending upon the producer and what they've held and their willingness to pull the trigger on completing the well, it makes perfect sense that would move forward. So that number of 130, though, when we've had a backlog that has exceeded 8,000 wells, and as we've talked in prior months, we could question whether all 8,000 are perfectly fungible from, why as an individual producer would I have thousands and thousands of wells in inventory if I can just add a gathering system, plug them in, and off they go. So, we have to see, I would say the productivity trends and the fact that the decline rates have been relatively modest, that those would be your first two factors in explaining why we're getting the production records, some 12.8 million barrels per day, new all-time record, number one in the world for the United States. So as that's continuing, that is the headline. Now, the question we've got about this shift in drilling activity, as it's come down now really for 3 consecutive quarters, is how far can we go where we keep setting these production records up and up, yet the drilling's going down? And there has to be some natural limit to that. But this is where we've been trying to do the sensitivity analysis, use the modeling tools that we've got to figure out, well, first, we're seeing more articles out there actually expecting that production growth will slow and or prices rise as a result of that. And then there's this dichotomy where the EIA has in its drilling productivity report and its short-term energy outlook this expectation that at least for the next 3 quarters, the drilling growth or the production growth for the U.S. year on year is basically just as strong as it was in early 2019 going into 2020. So that's a really interesting dichotomy between, is it an artifact of EIA modeling or is it the reality? And when we take it apart and try to look at each production area and the wells going in, if we get no productivity increase, and we have been seeing substantial productivity increases, but in 2020, if there's none, and if we just hold the rigs today constant into next year, we're still going to end up with 5 to 10% production growth. That's the reality of just how strong this is, coupled with that minimal decline rate. So the DUCs, it's not a red herring. It is substantial, and it has a lot of opportunity that goes with it. It's just not the main mover of the trend that's before our eyes right now.
And if our numbers are right, we're down 672 DUCs according to the EIA data since it peaked in March. So, for perspective.
Yeah, that's a pretty good number. That's not, 8% of the total from, and they've had a moving target. They actually got up as high as 8,800 DUCs at one point, and then retroactive went back and revised that down closer to 8,000. So the number has moved by that quantum. Yeah,
I'm going off of their March report, which is 8,246, to the report here for November, if I did the math right, but something like that. So anyways, sorry.
That's a lot of DUCs.
A lot of ducks off the pond.
Yes. I want to maybe talk a little bit more about this productivity growth, because we hear a lot in passing about, technological innovation has made everything, it's so much more productive, and this is going to continue. And what are we talking about in terms of productivity increases? Are we talking about new technology that is enabling this? Or are we just talking about, is this AI, the cloud, Bitcoin? I don't know. Let's throw out every tech buzzword I can think of. Or are we just talking like old-fashioned, general like productivity increases? We know more about how to do this now, and we can do it better and more efficiently, and we can squeeze more oil. Or there are new regulations, perhaps, that are making it possible so that not everyone is drilling in exactly the same place. So I don't know what unpack like this productivity, these productivity increases a little bit.
I mean, it's hard to do an exact attribution of it, but clearly all of the above are contributing. The first order
except Bitcoin, right?
Well, anything that if you take that as a euphemism for digital technology, real-time learning, there's no question that the digitalization and that is continuing to improve things across the board for the industry. So it is moving forward. Big data analytics are contributing. It's not Bitcoin, right? I mean, that would be very limited to transactional things about trading cargoes and having the history there.
I only bring this up because there was an article recently that I saw, which something like, can Bitcoin mining save the natural gas industry? Which I think was reflective of the idea that it takes so much power to power these like Bitcoin mining servers that like maybe they can just hook one up directly to, the Permian can it solve the flaring problem? I don't think we're quite there yet, but anyway. So digitalization of technology and these kinds of things. What are some of the other reasons that it's gotten so much more productive?
So look, Bitcoin would be quite attenuated. Digitalization and real-time learning and being able to target things better, understanding even at a molecular level why fracking is working and improving those recovery factors, the amount of oil and gas that are recovered as you drill, relative to the resources that are in place, all of that's important. The first order impact, and as API looks, we have a quarterly well completion report, and we also do kind of a postmortem. It starts with estimates, but over time, as if we go back a year, we get pretty comprehensive reporting across wells that have been drilled in the U.S. And what we see is that just increasing lateral lengths actually has had the biggest impact. So as those go out, a well's not a well anymore. A well entails a lot more underground potential than it used to. And as that's happening, it's natural that the productivity of those wells would also increase. So fewer holes in the ground, but more production potential. And that is real productivity when we measure how much we're actually getting. And you see that in the EIA's drilling productivity report, where for each major production area, they've got a column in their spreadsheet of backup data that breaks out, if I run a rig for a month in the Permian or the Bakken or the Haynesville, in various production areas, how much oil and how much natural gas do you get? And there is a third flavor in there because they haven't split out natural gas liquids. But in our own modeling, we've endeavored for each one to account for all of it.
The great Condi debate, that even hit OPEC this year. The great Condi debate. So that's really interesting, and I would assume that by drilling fewer holes and increasing lateral lengths, you also get costs go down, because I don't know personally. The truth is, I don't know. Is it less cost intensive to go more laterally than to build another rig? I'm guessing it is, but
they have. And the interesting industry trend that goes on this, we try to look through financial benchmarking across different sectors of our industry to understand the health, the productivity, where results are. And it's interesting that so much of the innovation of this productivity has come from the oil and gas service sector, yet a lot of these innovations have basically become commoditized almost as fast as they've come out. And as a result of that, it really is shared, and you're seeing it diffuse quickly across a lot of different production areas where these learnings, if it is something as simple as I'm just going to drill a longer well, that's pretty easy to copy, right? And if it's something about the molecular level of getting more out of that reservoir, then maybe not so. So, we need to see how these play out, but at least in terms of the way EIA is showing this across the broader production areas, these trends have looked really strong so far. And that's really the first thing we would look for to try to see if there's a changing of the guard, if you will, and where this is headed.
So can I ask a question about the longer laterals? That is a hot topic of debate here in the state of Texas, are the longer laterals better? And I'm curious, we don't have to get into all of the companies or wells you study, but are you guys studying this on just a general, we're going to pull a bunch of wells and then kind of run the numbers, or are you tracking it by maybe the producers who are doing it? Because it feels like the narrative right now in Texas is certain producers can drill long laterals and be very effective at them. Some drill long laterals and they don't get the same results. Deloitte issued a report kind of echoing the sentiment the other day, saying that really they feel like, and I'm summarizing here, but essentially that horizontal producers, it's really some of the people do a good job and some of them don't. So I'm just curious, did y'all got kind of blend into the numbers at that level, or is it more just kind of compiling a bunch of data and going, okay, hey, this is more of a general statement of the industry?
Well, I've mentioned two different approaches. So in our shale modeling, to really look at this productivity trend and what it means, you can think of that as more top-down in the sense we are calibrating to the drilling productivity report and looking at regional production level metrics.
Okay.
This quarterly well completion report, which we also publish, is literally well by well and building it up from the ground. So there's a lot of data that underlies that, and it becomes less estimate and more a measure of the population of wells over time. So look, it has to be in arrears to get that much data to represent the population, but it does show that there's a distribution, of course, but you're going to see that on average, as you've increased lateral length as a first order impact, it has improved the productivity.
Interesting.
Maybe we could switch a little bit now to the demand side, because there was a lot of interesting stuff going on in this report about gasoline and distillate demand, and it seems like there's this continuing growing dichotomy, I think is the word they use, of industrial growth and consumer confidence. And so I was wondering how you think this might change or might not change. We were talking about this earlier in the podcast, this phase one trade deal, and how long it might take for the changes to really filter into the actual economic indicators. You mentioned that trade is definitely an issue in the lagging industrial indicators. Do you think that, how many months is it going to take for us to maybe see an increase in distillate demand?
Well, that is the main input into our economic indicator, API, our distillate economic indicator by definition. And I think it's going to take a few months, because it's not, if you get a trade deal here, keep in mind this trade deal gets signed, technically the one that's been announced. It might get signed in January. It's not done until it's done. And assuming it does get signed, then it's going to take some time to turn those purchases around. So China is committing in exchange for reducing tariffs. And keep in mind, it doesn't eliminate. It just cuts some existing tariffs in half and prevents escalation of this further. And the next step in escalation was to hit the consumer side. So we're maybe de-escalating on the industrial side, but they're committing to buy a lot of agricultural goods along the way. That's the part that's probably been hurt the most, and especially going into election year with breadbasket of the United States, a lot of key states like Iowa. The optics of that with China not buying have been not great. So this is in terms of the production, the transportation of agricultural goods through the entire value chain, a lot of the manufacturing that goes with that, supporting the entire industry. This is an important source of potential distillate demand, and I would expect it, especially as you go into the planting season in the spring, ultimately get to the next harvest. That's where you'd see some recovery in it, but it won't be an overnight thing.
So, quick follow-up on that. One of the things Ellen and I were talking about was our lack of agricultural knowledge, and in that we had some questions. And so we've read a lot of headlines this year about Trump the federal government was subsidizing the farmers. Will it be as apparent as if he weren't subsidizing them, that they're going to have these exports? I don't know exactly what the subsidies all went for and where they were spent, but because he's no longer subsidizing them, but now we have a trade deal, will it be that much of a change, or can you break down if that will have any impact in how we read these numbers moving forward?
Well, having gone to Des Moines, having gone to rural Minnesota and spoken with people in agribusiness, this should help. Right? When the actual good flows and you produce it and you go through the cycle and you're not relying on either crop insurance or some sort of government make-whole to try to compensate you for what you're not selling, there are a lot of fixed costs that go with this kind of production where maybe you locked in on a contractual basis the ability to transport whatever you were going to produce, right? There are a lot of things that you can plan forward for that actually work as they're expected to work. And I think people feel better about the contributions they're making through the whole chain when it works as expected. And when you get thrown for a loop and suddenly this big source of demand growth in China turns off the spigot in a spat and decides not to buy at all, it's really at a country level, it's easy enough to look and say, okay, they changed their buying pattern. Some of this is fungible. Some of it goes somewhere else. But at the individual level, when there has been no other market to pick up that volume of soy production, for example, it really is hard. So this really should help, and it should ameliorate a whole industry as it goes with it. Distillate demand should pick up in tandem with that. The other thing that's gone, we had some unusual seasonal crop behavior this last year, and having propane available, for example, we would look from an industry level and say, well, the propane inventories have been ample, but the need to dry crops, the need with seasonal cold weather to make sure that you have heat, that you're keeping livestock, turkeys, chickens, in a coop alive through the winter. Propane has actually been really important in delivering that. And there have been regional shortages where it's just not been possible to get, from where you technically have inventory to get those final miles to go to where the demand's actually most needed. So there are issues that as we see a resumption in agricultural activity and trade should continue to have a direct impulse in what's happening in the energy sector and the demand side of it in particular.
Anything else, Ron?
I was also going to ask just briefly about. It seemed from the report that the indication is that the U.S. A lot of the demand, at least for petroleum in the U.S., is going into petroleum products, and then we've got a big market exporting them. That a lot of the increase in our oil exports is really in petroleum products, less in crude oil itself. But at the same time, we've seen an overall increase in inventories. And I was wondering how much of this is a seasonal issue that might shift over time. Can we, is this a seasonal buildup in inventories, or is this a real shift? Are we seeing a shift in, the way that the industry works?
Well, the real shift, and I do believe for your question, it really is a shift in how we work. The fact that the production growth has been so strong. On the inventory side, we've now had 13 consecutive months where if we look on the year-on-year growth in inventories, it's continued to accumulate. So that's not a troubling sign. It's a really good sign from a market perspective that despite the record demand that we've seen, despite the growth in exports, that the stocks are here, and that provides a nice cushion for consumers as we go through all kinds of variants. Now, in terms of where the demand is and how it's gone, we've seen some regional divergence in it. We've seen some interesting shifts. And I think that's par for the course. There is some seasonality that's in there. On the gasoline side, it was interesting if we kind of look at reformulated versus conventional gasoline and think of urban areas versus rural areas. Through most of the year, we're kind of seeing more growth in urban and less in rural, and then it's reversed at times. And that reversal has actually been kind of interesting because I think it's rebounding in times with what we're seeing seasonally and also this change in agriculture, as we mentioned. So, look, the conventional gasoline, the rural gasoline, is almost twice the volume of the reformulated or urban gasoline. And as we see this shift, it's really important from a growth standpoint to kind of monitor where that growth is happening. And both on the demand and the production side, it's interesting. We've been trying to break out where geographically in the United States we see growth and where we don't. And on the production side, both for oil and natural gas, the message is that the strong states seem to be getting stronger. Their production's increasingly concentrated in these states that are the most economic. And then on the demand side, it really is a regional story in the sense that who would have thought that up and down the eastern seaboard would be our strongest consistent source of growth, that we'd have, in the Midwest, as we've seen agriculture and manufacturing under pressure, both gasoline and diesel, for example, have been down year on year as a result. California led on the West Coast, not a surprise that that's down. Throughout the Rocky Mountain region, though, it's up substantially, quite large year on year increases. And then if we get to Texas and the Gulf Coast, it's actually been down on gasoline and up on diesel. So a divergent story based on whether you're really looking at the region's center of activity in terms of transportation and freight versus how consumers are feeling with the economy in region, where a lot of our industry has actually kind of been hurting this year. So maybe people aren't traveling as much or feeling as wealthy and secure as their jobs. And all of that plays into a really, when we think of financial markets hitting records here and try to think of how that paints a picture of the U.S. economy, we realize that it's very regionally varied. It has some interesting flavors to it.
Okay, final question, real quick. I was looking at the charts here. We talked about this some, but just curious, one of Ryan's crazy questions. We look at the residual fuel oil deliveries. If you look at the 2018 line, you look at the 2019 line, it's not a direct, exact opposite, but it diverges at a lot of points. A year from now, I know you can't make predictions, but is this a trend that surprised you, A, and B, we should look for going into 2020? Because you kind of look at it here. We've talked about the 5-year averages charts and stuff like that before, but this one's kind of has some different divergences, it seems like, especially early in the year. And then a few times later in the year, it's definitely gone the opposite of what it did in 2018.
So that's an interesting market, right? Because cutting over at January 1, 2020, we have the International Maritime Organization's tightening of sulfur fuel regulations for marine fuel. And we've talked in prior episodes about how, there have been a lot of ships, dry cargo ships, shipping around the world, but also out of the United States, where they've gone in parts of this year to have scrubbers installed. So, by requirement, if they want to continue to use this less expensive, higher sulfur, lower quality fuel, they basically have to have a scrubber on board. And that's a $4 to $7 million proposition to install one of those, and it takes time. So the ship has to go into a port, has to have that installed. And as that's happened, we've seen the freight shipping rates all over the map as many of the fleet have gone in. And I saw from one source an estimate that 1 in 10 ships globally now has a scrubber installed. Mm-hmm. So there is compliance that's building, and the compliance should be high for this in the United States, Europe, and Singapore. That explains some of the seasonal variance where you've seen, especially in April, May timeframe. In 2018, you had this normal peak up in demand for residual fuel oil, but yet in 2019, it was down, comparatively so, off the bottom of the 5-year range, actually. But now here we are at the end of the year, and it's relatively strong. So, the last couple of months, we've been expecting, actually, if you've got this shift away from residual fuel oil driven by the marine shipping market, you should see this number go down, right? And it is a mystery in the sense that we look at EIA's estimates of how many heating degree days there were, because residual fuel oil is also in the Northeast United States a heating fuel, right? But there are fewer heating degree days this year than there were last. So, when we look same months year to year, and that's down, all it seems to show is that the activity on the shipping side, still utilizing this on the industrial side as well, has still remained relatively strong. And we're waiting to see if there is a response in the inventory or the demand data to this impending approach of January 1, 2020 for IMO.
Okay, Dr. Foreman, I believe we are up against the clock. Thank you so much for coming in. API.org, go to the Chief Economist tab at the top right. There is where you can find that. The report will be out on Thursday. We'll link to the website in the show notes. Hope you have a great Christmas, good New Year. We'll talk to you, I guess, in January, huh? Be back in January?
Back in January. Look forward to it. Hope you all have a great holiday.
See you in January.
Thank you, Dr. Foreman. Okay. And once again, that is Dr. Dean Foreman with the American Petroleum Institute. We will link to all of that stuff on the show notes, so you can check it out, the report, and we will have him on again in January to talk about what's going on then. IMO 2020, Ellen, we've been talking about it for years. It is here. Next podcast we record will be an IMO 2020 life.
Yes.
The world will be different. Things will be completely different than they are today. Come next year, when we come back, it will be IMO 2020 time. And that's going to dominate the news for half an hour.
all of us will be our IMO 2020 compliant, right?
Oh, yeah.
Have you installed your multi-million-dollar scrubber?
I got a scrubber on my diesel truck. I put it in last week. So it's...
I'm actually thinking of heading down to Jacksport to, with my digital camera to try to film and catch people who don't have scrubbers. I don't know what scrubbers look like. I don't know where they are. I don't know anything about ships, but it just seems like a thing to do.
Well, we will be back after the new year. And so be sure to listen to all of these podcasts between now and then. And Ellen, in the meantime, they can find you at Energize Economy on Twitter, investing.com, Forbes, Bloomberg, the White House briefings.
All of those places.
OPEC, minister meetings, stuff like that, here, there, and everywhere. Listeners, thank you for listening to us this year. Look forward to talking to you next year.